relatively high productivity. We've got unemployment, pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs, so you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And, the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment, because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening? In
labor or in other?
In labor and inflation, just across the economy. Have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up, but prices also went up on dryers, which were not tariffed. So the manufacturers just, they just kind of followed the crowd and raised it. So things happen very indirectly, and so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases.
Real quick, I like how that was explained, where just because something doesn't have a tariff directly, it can still be indirectly affected by pricing with the overall market, or I guess for washers and dryers, it's overall industry.
Haircuts, daycare, everything else. And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last?
Pandemic, yes, during the pandemic.
You could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course we're well aware of that, and it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. We haven't had real price stability fully reestablished yet, and we have to keep that in mind. And we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
So we have two goals, right? We have maximum employment and price stability, and we have to balance those. And, there can be situations in which they're in tension. right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is, each of those two measures is from its goal, and then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecasts that really show significant problems like that.
Well, just to follow up, yesterday, the UCLA Anderson forecast said there's a high probability of a recession. Where do you stand on
Strongest
whether or not
candle of the
slowdown
day
you're
so
seeing
far.
creates a higher probability or concern that you may have on recession? Thank you.
There's always an unconditional possibility of a recession. It might be broadly
Get a
in the
new
range
weekly
of
high.
1 in 4.
The overall
at any
market
time,
has-
if you look back through the years.
The overall market started today kind of 50-50. Particularly, I was looking at Target was down and QBTS was down 5%. It's moved up. A couple more of these guys kind of flipped, or they extended their green days. So we're seeing that reflected right here. The overall market is pumping a lot right now, hoping that we can create a new high for the week.
Extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Chris.
Likelihood of a recession is still low, but probability has increased, I believe is what he just said. I know I had it muted, so I didn't get to capture all of that.
This could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I no desire to change that answer and have nothing new for you on that today.
Well, maybe I'll have another mulligan.
Wow.
As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing that, what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. We look at it, we don't dismiss data that we don't like, we force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but nonetheless we take notice of it.
Michael McKee from Bloomberg Radio and Television. There's a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the timeframes and all that, and we will use our tools to foster achievement of our goals to the best we can, and of course we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty.
Did my window freeze?
Do you think it's going to be hard to
Uh-oh. I've still got audio coming through.
get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. These decisions are going to be made and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. those things will happen. A lot of them will happen over the course of, in coming months, certainly over the course of this year. And we'll be adapting as we go.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions.
Going
At
higher.
the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation.
Tesla
Can
up
you walk us through
$12
what
on the
that
day.
looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of
JPM just
saying
said
that
one of my
things are highly
targets. My next one's
uncertain,
at 245. I had a student ask me
you're
about
reading
this. If
about
I'm looking for
developments, the news is
240,
full of
I told them
developments
yes,
of tariffs
and then I
being put
told
on
them
and taken off
245 is
and
the
things
next
like
one.
that. That's
We're at
some of that is
241 so
noise
far.
in the sense that it's not really telling you anything. You're trying to extract a signal from that, and the signal is what's going to be
Tesla
the
keeps on
effect
going.
on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was.
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. The idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero, and you have to ask, it's coming during tariffs, but you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories, which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know. In a couple of months, we'll know whether those were, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be
Still
able
waiting
to say
to
with
pass the
confidence
weekly highs
how
right
much of
here.
that came from inflation and how much of it, from tariffs and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what, in your mind, would make something cross from noise to a signal, what that threshold would look like?
It would depend on what we're talking about.
So just because I'm looking for price to break this high does not make me a market bull. I would ideally like to see price at least come this high, maybe even as high as this, before I start considering the market to be bullish again. This is just something I'm eyeing in the short term, not to determine my personal sentiment of the market.
Now it's slow, but it's definitely moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Kelly.
Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices. It's they're unhappy, and they're not wrong
Looking
to
a
be
little
unhappy that
higher on the
prices
new
went up
candle.
quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has
Tesla now
been
past
for a
$13
long time,
on
a
the
couple of
day.
years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have 4.1% unemployment. We've got 2% growth, and it's a pretty good economy. But people are unhappy because of the price level, and we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So I think remember we came into this with, at the December meeting, the median was 2 cuts, the median was. And so you come in and you see, broadly speaking, weaker growth but higher inflation. And they kind of balance each other out. So you think, and unemployment is there's really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. Is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in through the reserve banks and put in the beige book, and also through contacts at the board. And we get all that, and we do understand that sentiment has fallen off pretty sharply, but economic activity has not yet. And so we're watching carefully. So I would tell people that the economy seems to be healthy. We understand that sentiment is quite negative at this time, and that probably has to do with turmoil at the beginning of an administration that's making.
I talked about this with my
big
students.
changes in areas of policy, and that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more about the price level.
Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify. You were talking about how tariffs were a good part of the uptick in the inflation forecast, and I was just wondering what that specifically refers to. Is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how the debt ceiling, raising the debt ceiling, might affect the reserve supply?
Yeah. So in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not, but some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have tariff inflation affecting core PCE inflation.
Got a little bit of an
core
uptick, but
CPI inflation this year, without exception.
really
I'm
slowing
not
down
aware of an
momentum
exception.
right
So
now.
it's in there. I can't tell you how much.
Is
of
the
that it
start
is.
of the hour though? So
In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly, committee that came around to the view that we would do the same thing we'd already done, which is I guess in June, was it June, whenever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's going to be slower for longer. And people really like that. People thought that's a good idea. It's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and we by the way, we still think that reserves are abundant, although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. Now, of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying
number we're
signal.
looking for is 569.72.
It had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful, rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the
30
level we
cents
judge
away.
as ample. And clearly, we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Oh, another real uptick.
Claire Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question others have asked, if they're not so well anchored, why hasn't there been a more radical shift to the policy path today? Thank you.
So when we talk about inflation expectations being well anchored, we're talking about longer
10
run
cents.
inflation expectations. And they really haven't moved much. I mean, if at all. There's one
Almost
reading that everyone's
$15 up on
focusing
Tesla for
that's
the
higher,
day.
but the other survey readings and the market-based
QBTS
readings all
lowering on
show
the red.
relatively,
Everything else increasing on their green.
well-anchored
Market's
inflation
moving up today.
expectations. You would expect that expectations of
Still
inflation
gotta hit
over
that
the
new
course
high,
of a
though.
year would move
Oh, we
around
did hit it.
because conditions change.
Here
In
we
this
go.
case, we have tariffs coming
New
in. We
weekly
don't know
high.
how big,
Let's
what
see if we can
speed,
get up to this
there's some
level.
things we don't know, but we kind of know.
Right
there
here,
will
we
be
want to see a
tariffs,
break
and
above
they
here. We
tend
want to see a
bring
couple of the
growth
higher
down, they
frames,
tend
my
to
4-hour
bring inflation
daily,
up
my weekly.
at the-
We want
in
to see
the
them
first
open and
instance.
close
So-
above here before
so
we
I
can
would
start.
say, I'm not
Not before we can
dismissing what we're
start
seeing in
buying, but
short-term
before we
inflation
can start
expectations. We, as I
uh,
mentioned, follow
buying
that
larger
very
orders
carefully.
or swing
But when we
trades,
say
day-to-day
expectations
trades.
are,
My position trades,
well
I've been
anchored, we're
stacking
really
them
looking at,
all
longer
throughout
terms,
this. I'm
5 year
stacking
and out, and there's
position
really no
trades, right?
story
I'm
to
averaging
tell
down my
5 years and
pricing.
out, either in market-based or in surveys. But we'll watch it. I mean, we're
Here we
not,
go.
you know,
570.
we're not going to miss any evidence that longer-term or medium-term inflation expectations are
575, and that would
are
technically
moving.
be my new bullish zone right here, right? If this is our
Chair
DNT
Powell,
zone.
Neil Irwin with Axios. Treasury Secretary Bessent has occasion. Do you agree that there's some weakness in underlying private job growth, and do you see the composition of job growth as something that has policy implications?
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in, you know, educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving in a healthy range. I mean, they're all jobs, but and remember, we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment.
Slowing down again.
But
right, we got that
the elected
nice little
government is
pump for
entitled
about
to have,
$1, 50 cents to
we
$1,
have
we'll call
policies
it.
that address different kinds of employment.
Now we're kind of
But-
stalling
but
a little bit.
The elected government has a different role, and they can have those.
Here's a quick QT question. Does the committee envision at some point tapering the MBS runoff
Another
as
new
well?
high.
I think
As soon as I
tapering
say
it,
it
I don't
starts,
know. There's no
bumping.
plan to do that. You know, at a certain point, we'll stop runoff. And we may or may not stop MBS runoff, though, because, you know, we want to stop runoff in net at some point. We haven't made any decisions about that. You know, we want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. You know, I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in, you know, constant at some point, a point that we're not out yet.
Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today you've said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, plunge in confidence surveys. Today, not only did the S&P
couple
mark down the
downticks right
growth
there.
outlook, 17 of 19 see risks to the downside. So my question is, how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at, you know, we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy, and that's what I mean. I mean, I think that's well positioned. Forecasting right now, forecasting is always very, very hard, and in the current situation, I just think uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move, and as I mentioned, I think we're well positioned to wait for further clarity, and not in any hurry.
Bulls should be excited, right? They do have a green day here, but
Thank you, Chair
it
Powell.
is very important to be reminded of the month-long downtrend that we've seen, right? So just be careful. It's a nice green day. We got a little pullback right now, but it is a green day. So just be careful, right, where the market is headed currently.
Now more concerned about inflation.
That's why we wait
or about
until we get into our
Actually, does
zones,
not
our
mean
safer
either of those
zones.
things. You know, sometimes with language, it lives its useful life, and then we take it off, and that was the case here. There's really not meant to be any signal here. Over the past year, you know,
Oh, a little halfway
conveying a
pullback
sense
on
of
that
the balance
candle.
of risks was important, that they be in balance or close to being in balance. That was useful as we approached liftoff, if you remember.
Seen a
But
couple
we're
of pullbacks
past
on the
that.
side
Oh,
here
sorry,
as well,
no,
right?
Beginning to cut.
Down from
So
15,
we just
maybe even
took- we
16
just
now,
took
I
it out.
believe.
I actually would say that the more important thing now about risks,
JPM,
and this is in
almost
the,
242.
pages like 10, 11, 12 of the SEP, if you look, participants widely raised their estimate of the risks to our of uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market, the stock market has obviously declined significantly since the Fed last met. Are you concerned at all about some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
So financial conditions matter to us because, financial conditions are the main channel to the real economy through which our policy has its effects. So they're important. But what matters from a Fed standpoint for the macro economy is material changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any market, equity, debt, commodities, or anything like that. And I would just point you to the bigger picture again. The real economy, the hard data, are still in reasonably good shape. It's the soft data, it's the surveys that are showing, significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but, we don't want to get ahead of that. We want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly, and of course we'll understand that. But you don't see that yet.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you look to navigate higher inflation and lower growth, the Fed has talked about heeding the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Well, fortunately, we're in a situation where we have seen inflation move down from, higher levels to pretty close to 2%, while the unemployment rate has remained very consistent with full employment, 4.1%. So we now have inflation coming in from an exogenous source, but the underlying inflationary picture before that was, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. Underlying inflation is still running in the twos, with probably a little bit of a pickup associated with tariffs. So I don't think we're facing, I wouldn't say we're in a situation that's remotely comparable to that.
And last month, the idea of a Doge dividend was proposed, which would send $5,000 checks
Give
to
me my
every
money.
taxpayer from Doge savings. President Trump and Elon Musk have supported this. There's reports there could be a bill introduced on Capitol Hill. What impact might that have on household savings and spending in terms of your growth and outlook for inflation?
It's not appropriate for me to speculate on political ideas or fiscal policy for that matter, so I'm gonna pass on that one. Thank you.
Daniel.
Hi, Chair Powell. Daniel Avis from Agence France Presse. You mentioned that tariffs are already having at least some impact on inflation. I'm just wondering how you and your colleagues on the FOMC have been thinking about the possibility of retaliatory tariffs from other countries, especially with April the 2nd coming up. Was it something you considered during this meeting? Thanks.
So since the very beginning, we've had kind of a placeholder. The staff has a placeholder of a range of possible outcomes from tariffs and from trade policy generally, and they generally assume full retaliation in those. And so that's kind of baked into the numbers. What happens, it will be complicated, and there will be some retaliation and some not, and all that. But ultimately, they're trying to, with the placeholder, give us a broad sense of what this might look like. When we actually know the specifics,
NVIDIA about to hit 120.
Still uncertain, but better informed forecasts.
Saw a lot of people posting about how they think it's start of a continuation of their bearish trend.
Hi, Chair Powell. Jean Young with MNI Market News. Had a couple questions on the balance sheet change that you made. So the minutes had initially described your discussion on slowing QT as temporary. until the debt ceiling is resolved. But from what you said earlier, it doesn't sound like there's a desire to kind of regain the pace of QT that we have at the moment after the debt ceiling is resolved. Is that the case?
Yeah, so we looked at pausing and we looked at slowing, and really people came together very strongly behind slowing, not pausing, for a variety of reasons. And so people really came to be, pretty strongly in favor of this move.
Still floating around
slows
50%
down
on
the
that
path, and probably lengthens it, doubles it effectively by slowing by half. That people thought that's a good place to be. It'll help us assure that this path is a smooth one as we get closer and closer to that. So that's how that came about.
Well, I guess my question is more, was that meant to be a temporary measure during the debt ceiling episode, or?
It was actually the TGA flows, Treasury General Account flows, that got us thinking about this. But the more we thought about it, we came around to this. And it is, yes, it was provoked. The original discussion was provoked by that. But I think what we came up with, though, was broader than that and different than it. It does address that issue, but it really is also
below
it fits
50% of the
in really
candle.
Nicely with our
It might go
principles and
below
our
this high.
plans and the things we've done before and the things we said we would do. So that's why pretty strong support. I just say it's nothing to do with monetary policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment as you get closer and closer. Let's slow down a little bit again, and that way we'll be more and more confident that we're getting where we need to get. You can take our time getting there. We're shrinking the balance sheet every month, and we think it was a good play, and as I mentioned, well supported. Thanks very much.
We were looking at the 1 hour the whole time. I should have had on a lower frame so you guys could see reactions quicker, but we were really targeting this high right here. We broke that. We're coming back down now. We're below 50% of this candle. Speeding up a little bit to the downside, but the market's green, right? All right, guys, so the meeting's been over for, I want to say 15 minutes. Market's pulled back a little bit. Bullish, bearish, winner, loser. I hope you guys learned something. I hope you enjoyed. I know there wasn't a whole lot of commentary going on. I was paying attention. I was doing other stuff in the meantime as well. But stay careful in the markets. If you are a bull, just make sure that you are keeping in mind, once again, about this month-long downtrend, right? I trade in a manner where I want to be very safe, so I'm waiting for something like my bullish zone up here to break through. Everything's subject to change, so this doesn't mean I'm absolutely going to buy at this line. If that's something you guys want to learn about, you can hop in my Discord or hop in a live call with us so we can record a couple sessions.